This screencast will explore the business operations and use of a petty cash fund. Well, before we begin, what exactly is a petty cash fund? A petty cash fund is an established amount of cash kept on hand by the business to pay for minor expenses, such as purchase of office supplies, postage, and deliveries. So what does the petty cash fund process involve? Well, there are three key operations. A business establishes a petty cash fund by cashing a check for a specific amount of the fund. A journal entry must then be made by the business to record the establishment. Let's say a business, Chang's Ice Creams, cashes a $200 check on the 5th of January to establish a petty cash fund. The journal entry is as follows. Petty cash is debited for the amount of $200 and cash is credited. Note, there is no reduction in total assets. There is simply an allocation of cash to the fund. The next step is payments from the fund. Payments from the fund are made either directly from the fund or employees seeking reimbursements. No journal entries are needed at this stage. However, the business must collect receipts and authorizations of transactions in order to assist with the last step. Replenishing the fund. A business replenishes the fund by cashing a check for the amount needed to bring the balance back to its original value. Receipts collected from payments are used as documentation for recording expenses. A journal entry is made to record the replenishment of the fund. Suppose Chang's Ice Creams review the petty cash fund a month later and prepare this report. They determine the fund needs $130 to be replenished. Note this amount is equal to the total receipts which record fund expenses. To replenish the fund, the business will then cash a check for $130 and record expenses in a journal entry. This entry increases expense accounts and decreases the cash account for the amount of the check. Because the business is recording expenses resulting from fund use, both assets and equity decrease. The golden rule of replenishing a fund is that the amount of cash needed to replenish the fund equals the total amount of receipts. Sometimes errors are made such as misplacement of receipts or incorrect change. So how do businesses account for these mistakes? When there are discrepancies, the difference between receipts and cash needed is charged to a temporary account called cash over and short. Cash over and short can either have a credit or debit balance when recorded in the journal. A debit balance increases expenses and a credit balance decreases expenses. Hope you now know what a petty cash fund is and how to account for it. Thanks for watching this screencast.